Welcome to vTalkInsight // 2013 Allocators Lens Daily for April 15th, 2026. Cross-asset signals are diverging, with equities pressing toward new highs while rates and commodities grapple with an unresolved energy shock and uncertain inflation path. Let's begin with equities, where exuberant earnings and AI enthusiasm are running up against rising input costs and geopolitical risks. Equity markets are leaning firmly risk-on, with the S&P 500 recovering war-related losses, closing up about 1.2% yesterday, and sitting less than 1% from a new all-time high. Growth stocks have sharply outperformed value. S&P growth is up around 9.5% this month versus roughly 2.5% for value, and momentum has been powerful, with a factor up double digits and semiconductors gaining about 16%. Small caps are up near 9% year-to-date, suggesting the rally is starting to broaden beyond mega-cap tech, even as breadth overall remains narrow. Under the surface, strong earnings are a key pillar of this resilience. Large banks, such as JP Morgan and Citi, have reported robust results, with double-digit gains in trading revenues and investment banking, while BlackRock has posted exceptional earnings on the back of hundreds of billions of net inflows. Tech and AI remain central. Hyperscaler and semiconductor names are benefiting from inflecting free cash flow expectations and persistent demand for compute power, and the AI cycle is seen shifting from heavy capital expenditure toward monetization. On the macro side, a softer-than-expected producer price report, including flat services inflation, has reinforced the idea that core price pressures are easing even as energy stays volatile, giving equities more room to look through near-term inflation noise. That optimism is being expressed through very ambitious earnings assumptions. Street consensus now looks for close to 18% S&P 500 earnings growth in 2026, up nearly 3 percentage points since January, while markets are already discounting roughly 14% growth as a base case. Yet leadership is concentrated. Only around 175 stocks have risen since late February, with energy and AI-linked sectors carrying much of the load, just as we saw earlier this week. Luxury and some consumer names tell a different story, with LVMH suffering a 50% drop in Middle East sales and a 2% decline in key divisions, highlighting how regional conflict and weaker demand can quickly pressure earnings outside the U.S. tech complex. The main equity risk now looks less about top-line growth and more about margins. Input costs are rising across the board, from oil and freight to plastics, aluminum, and copper, and corporate margin compression is cited as a key threat if companies cannot fully pass those costs on. At the same time, AI-enabled productivity and cost savings are expected to offset part of that pressure, especially for tech-driven businesses, reinforcing a barbell between innovative, asset-light models and more commodity-exposed sectors. Looking ahead, allocators are likely to focus on upcoming earnings commentary around cost pressures, the durability of demand in Europe and luxury, and whether market breadth finally improves beyond energy and AI, particularly as the April 21st ceasefire deadline approaches and could challenge the current benign geopolitical pricing in equities. Turning to rates, the picture is more cautious than equities suggest. U.S. Treasury yields have edged lower across the curve, with the 10-year slipping by almost 2 basis points, consistent with renewed demand for safe haven assets amid Middle East uncertainty. In Europe, Italian and French 10-year yields fell 5 to 6 basis points, also pointing to a defensive bid, while a recent UK 10-year auction drew record demand, even at yields close to 4.9%, the highest since 2008. Japanese government bonds are seeing their strongest demand since 2019, reinforcing the idea that global investors are willing to own duration at today's higher yields when geopolitical risk flares. Despite that demand, the policy narrative still leans toward higher for longer and potential curve steepening. Markets now expect only one Federal Reserve rate cut this year, with another cut pushed out to 2027, as core inflation is seen hovering near 3%, above the Fed's own forecast. In the euro area, the central bank places the economy between its baseline and adverse scenarios, with inflation projections running from about 2.6% to just above 4%, and officials stressing a data-dependent stance and readiness to act if inflation proves persistent. Curve steepening of another 25 to 30 basis points is seen as plausible if investors further price out near-term Fed easing. especially given limited policy flexibility in many developed markets that already face high inflation and loose fiscal conditions. Policy divergence is another emerging theme. The euro area could still tighten while the Fed remains on hold, whereas the UK and Japan are emphasizing growth support, contributing to steeper yield curves and putting pressure on their currencies. Overlaying this, the Gulf energy shock and rising metals prices threaten fresh inflation pulses, even as U.S. producer prices and grocery costs have softened and some see energy spikes as temporary. One view is that a major oil shock today might trigger demand destruction and eventual Fed easing rather than another hiking cycle. But the rates market has not fully settled on that outcome, keeping the yield curve and front-end pricing key signposts for allocators. In credit, the message is one of resilient cores but more fragile edges. Major U.S. banks such as J.P. Morgan and Citigroup have reported strong quarters, with record equity trading revenues, double-digit growth in fixed income activity, and solid investment banking fees, all pointing to healthy capital markets and robust balance sheets. BlackRock's large inflows into exchange-traded and retirement products reinforce that there is still plenty of demand for public credit and diversified fixed income exposure. Yet not every institution is shining. Goldman Sachs delivered an earnings miss that unsettled parts of the fixed income market, and Wells Fargo disappointed on net interest income, investment banking fees, and credit loss provisions, reminding markets that bank performance is far from uniform. Private credit sits at the intersection of these strengths and concerns. Wells Fargo's disclosure of about $36 billion in private credit exposure sparked worries, while Citigroup reported roughly $22 billion with zero losses so far and emphasized conservative structures. Most of these exposures are to relatively lower risk areas, such as loans to insurers or capital call lines to private equity, and portfolios are generally diversified with modest advance rates, leading regulators to see limited systemic risk today. However, direct lending to middle market firms has not been tested through a full downturn, and any stress there could weigh on bank equities and raise questions about pockets of illiquidity, even if the broader banking system remains sound. Beyond the banks, a rising cost of capital environment tends to challenge the most leveraged borrowers. Highly indebted European sovereigns, such as France, Belgium, and Italy, are seen as vulnerable to wider spreads if yields stay high and growth disappoints, while lower quality corporate issuers, especially in high yield, look more exposed as financial conditions tighten. Central banks and supervisors are explicitly highlighting the need to monitor both known and hidden vulnerabilities, including potential so-called black swan events. For multi-asset allocators, the evolution of spreads between high and low-quality credit and between core and periphery sovereigns will be crucial in judging whether current issues stay idiosyncratic or evolve into a broader credit repricing. In foreign exchange, the main story links policy choices to currency performance. Countries that are prioritizing growth over inflation control, notably the UK and Japan, are experiencing steeper yield curves and softer currencies, signaling that markets demand more compensation to hold their debt. That combination of higher funding costs and weaker currencies leaves them more exposed if energy or food prices rise further, particularly given their reliance on imported commodities. By contrast, the euro area is leaning more hawkish, with room to tighten policy even as the Federal Reserve looks inclined to stay on hold, which would support the single currency but may weigh on growth-sensitive assets. From the wider cross-asset picture in recent days, the dollar still benefits from its safe haven role, but flows have been more nuanced than in past crises, with interest also seen in other perceived havens. FX volatility is therefore poised to react quickly to any break in the ceasefire narrative, to surprises in inflation data, and to signs that the energy and metal shocks are feeding more durably into domestic price levels. Commodities remain the macro fulcrum, with energy at the center. Physical oil supply from the Gulf has been severely constrained, with tanker traffic through the Strait of Hormuz reportedly collapsing from well over 100 ships per day to only a handful, driving up freight rates and forcing some vessels to idle. Insurance premia for ships in the region have surged from pre-war levels well below 1% to as high as 5%, and in some cases cover is difficult to obtain at all, adding another layer of cost and uncertainty. The International Energy Agency warns that the conflict poses a major global energy security risk and that no economy is fully insulated, especially if the closure of the strait persists for weeks rather than days. Despite this physical tightness, headline oil prices have recently eased as markets focus on diplomatic efforts between the United States and Iran and rising odds of a ceasefire this month. Energy risk premia have declined as traders assume that talks will prevent further damage to infrastructure and that any shipping pause will be temporary. However, some commodity specialists argue that expectations for oil are too low, pointing to a likely move toward at least $85 per barrel by year-end and noting a significant gap between stressed physical markets and relatively relaxed pricing. The April 21st ceasefire deadline is a clear catalyst. Failure to make progress could force a rapid reassessment just as the summer driving season approaches. The energy story also extends beyond crude. Disruption of key shipping straits threatens around 20% of global oil and gas flows, as well as critical inputs for fertilizers and microchips, raising the risk of renewed pressure on both energy-intensive manufacturing and food prices. Authorities expect that even once hostilities cease, restoring normal shipping conditions will take 2 to 3 months, while repairing damaged refinery and energy infrastructure could take years, implying a long tail of supply-side pressures. Global institutions have already trimmed growth forecasts by about 0.3 percentage points in response to the energy shock, and base case expectations for food and goods inflation now sit somewhere between normal conditions and the extremes seen during the pandemic. Industrial metals add a more structural layer to the commodity picture. Conflict in the Middle East has removed roughly 4% of global aluminum production, pushing the market into an estimated 2 million ton deficit, doubling physical premiums in Europe and drawing down warehouse stocks as supply struggles to keep up. Alternative production is hard to scale quickly because key regions face electricity constraints, while Europe has become more reliant on Middle Eastern supply after cutting back on Russian imports. Meanwhile, copper prices are supported by expectations of government stockpiling and persistent supply constraints, with forecasts keeping prices well above traditional investment incentive levels, and multiple governments are openly discussing strategic stockpiles of base metals. Gold sits slightly apart. Steady central bank buying underpins demand, but rate-sensitive exchange-traded fund flows have turned negative, limiting near-term upside, even as macro uncertainty stays elevated. Taken together, the commodity complex still points to meaningful upside inflation risk, even as parts of the inflation data in developed markets are softening. Across assets, the central tension is clear. Equities are leaning into a risk-on narrative built on strong earnings, AI-driven growth, and confidence that energy and geopolitical shocks will prove manageable, while rates, credit, FX, and commodities all flag that inflation and growth outcomes remain highly path-dependent. Higher for longer policy risks, fragile credit fringes, policy-driven currency moves, and a tight commodity complex together suggest that the distribution of outcomes is still unusually wide, with the April 21st ceasefire deadline and the next round of inflation data likely to be key catalysts. For allocators, watching how earnings guidance, yield curves, sovereign and corporate spreads, and commodity prices respond to those catalysts will be critical in judging whether the current risk-on stance can be sustained or needs to adjust. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.